Joint ventures, topic 5. Okay, few people are saying yes. All right, so just a quick little recap then. If you did watch the video, then you pretty much got the overview for investments in joint ventures. So key things to know is that a joint venture is it's a type of joint arrangement where two or more parties, two or more investors basically, agree to share control over a business in which they have an interest in the net assets. The net assets is another word for basically shareholders' equity, right? So if you have an equity interest in the business and control is shared, then that's a joint venture. So typically a joint venture is typically structured as a separate company, right? A joint venture will be typically structured as a separate company, and the venturers are basically its shareholders. Shareholders in the joint venture, right? Each of the venturers owns a percentage of the equity of the joint venture. As per IAS 28, the investment in a JV must be accounted for under the equity method. Right? Now, as far as the venturers are concerned, the venturers may be founding or founder venturers, right? So these are those that originally established the joint venture, right? So that's founder venturer, or may acquire their interest from an existing venturer. So that is also possible. You can also have a situation where a company could buy ownership in a joint venture from another company. They do not have to be equal partners, right? So the venturers share control equally, but may not own equal percentages of equity. So it is possible for a two-company joint venture, could be 50-50, but it could also be a 60-40 joint venture. But the company that owns 40% of the shares still has equal control, right? So that's the whole philosophy in a joint venture, that the parties share control. There is no single owner that has more muscle power than the others. Okay. So what are some of the accounting bits that we need to know, the accounting considerations? We will need to know how to account for the initial investment in the JV. So as far as the initial investment is concerned, say if we are looking at a founder joint venture, a new joint venture is formed, and the venturer invests cash. So from the point of view of the venturer, so this is all accounting from the perspective of the venturers, right? So we're not talking about the accounting in the books of the joint venture. In its own books, the joint venture will record transactions just like any ordinary company will. So we're talking about it, the accounting considerations from the investor, the venturer's point of view. So if a new joint venture is formed and the venturer invests cash, it's just a matter of debiting. You want to debit the investment in joint venture and credit cash. Now, mostly what tends to happen is that a new joint venture is formed and the venturer invests assets other than cash. So if the venturer invests assets other than cash, then we have to consider, okay, we apply the fair value rule. And as per the fair value rule, the fair value of the assets transferred to the joint venture equals fair value of consideration received. Okay? Fair value of assets transferred equals fair value of consideration received. So what does the venturer receive when the asset is transferred? So there may be instances. So first of all, for the assets that are transferred, the basic rule here is when the venturer invests assets other than cash, the venturer must derecognize the asset from its own books. All right. And they will record the investment in the JV. By applying the fair value rule, with regards to the derecognition of the asset transferred, there may end up being the question of gain or loss on the asset transferred. If the fair value of the asset transferred to the joint venture is different than its existing book value, then there will be the question of gain or loss on the asset transferred. Also, we have to consider other than the gain or loss on the asset transferred, we have to consider if the venturer receives any asset in return other than the investment in the JV, right? Then that must be recorded, right? So that other asset must be recorded. Now, when we are dealing with the gain or loss on the asset transferred, we will recognize a portion as realized gain on transfer immediately. So recognize immediately a portion, and the rest is deferred, right? So the rest is deferred, i.e. considered unrealized, and will be recognized later over the remaining useful life. So Feroz had a question, what you meant by asset transferred. So if the joint venture is formed and the venturer invests something other than cash. So if you don't transfer, if you don't invest cash, but say instead decided to put in land or equipment or buildings, some other asset. Okay. And Feroz, if you just joined in, you may want to access the file here. You can then take notes as we go. All right. So with regards to this gain or loss, the amount to be recognized immediately depends on amount of gain realized and deferred depends on whether the transfer has commercial substance. Now, you guys learned about commercial substance in your first intermediate accounting course when you were learning about exchanges of assets, non-monetary exchange of assets. That's when you learned about commercial substance. Basically, commercial substance is said to exist when the company experiences a change in its economic position. And that change in economic position is evidenced by a change in the nature, amount, or timing of cash flows. So if the company experiences a change in the amount, the timing of cash flows from the asset, then we say the transaction has commercial substance. For our course, this part will be given. So the problems will indicate whether the transaction has commercial substance or not. If nothing is mentioned, assume commercial substance exists. Okay, so if a question does not say anything, you want to assume that the transaction had commercial substance. It's only when you're explicitly told that the transaction does not have commercial substance that that you will need to know what to do in that case. Okay, so if commercial substance exists, then the amount of gain to be recognized immediately is equal to total gain times the other venturer's share. So if we own 30%, then the other venturers will own 70% of the joint venture. 70% of the total gain on transfer is considered to be realized right away. That is, the remainder will be deferred. If there is no commercial substance, in that case, the amount of gain to be recognized immediately depends on whether the venturer got any assets other than the investment in the JV. So the calculation in that case is total gain times any other assets received. So other assets received divided by fair value of the asset transferred. Okay. All of this is there in your lesson notes. I'm just kind of giving you a very, very, very high level recap here. This piece that I talked about, we're going to see in example 5.1. All right. So I want you folks to take some time to read the question. I'm going to give you a couple of minutes. I'll pause the recording for that time. All right, here, this is an example of a joint venture being formed. Jarhead is the name of the joint venture. It was formed on Jan 1st, 2001. Garfield is one of the three founding venturers. Garfield happened to invest equipment in the joint venture. All right, so applying the fair value rule, the fair value of the equipment transferred, which is, according to the problem, the fair value of the equipment transferred is, hang on, this is too big. Maybe this is good. Fair value of the equipment transferred is how much? Hugo, you want to read the question again? $2 million, okay? The venturers agreed that the equipment had a fair value of $2 million. 1.6 million, Hugo, was the carrying amount, okay? Carrying amount is net book value. The fair value of the equipment transferred is $2 million. That is equal to fair value of consideration received. Now, what did our friend Garfield get in return? Garfield got a 35% interest in the joint venture and $800,000 in cash. So they got cash 800,000, and they got a 35% in share in Jarhead Limited. And so that's the investment in Jarhead. How much is the investment in Jarhead worth now? If fair value of the equipment transferred 2 million is equal to fair value of consideration received. And the consideration that is being received by Garfield is made up of two pieces. They got cash of $800,000 and they got a 35% share in Jarhead. How much is the investment in Jarhead worth? $1.2 million. Thanks, Julia. That is indeed the case. If 2 million is the fair value of the equipment transferred, that 2 million fair value of equipment transferred is equal to fair value of consideration received. So fair value of consideration received should also be 2 million. That 2 million, if it includes 800,000 received in cash, then the investment in Jarhead has a dollar amount of $1.2 million. Okay? That's the first thing to remember. Second thing, the fair value of the equipment transferred is $2 million, but what about the book value? So first of all, what was the original cost of the equipment transferred? How much did the equipment originally cost us? 3 mil. What's the carrying amount? $1.6 mil. What's the difference between cost and carrying amount? What's that called? Cost minus net book value. What is that called? Think, this is your last financial accounting course, right? Thank you, Hugo. That's the accumulated depreciation. So we shouldn't jump to answers. Doesn't hurt to think a little bit. The difference between cost and the net book value is the accumulated depreciation. Thank you. We need these moving pieces. When we de-recognize the equipment, we not only credit the equipment for its cash, the cost amount, but we also need to debit the accumulated depreciation, right? So we're trying to go through those calculations. Yeah. Now, if the carrying amount is 1.6 mil and the fair value is 2 mil, then what is the total gain? $400,000. The fair value minus the carrying amount, 400,000. This 400,000 needs to be split between two parts. There's the amount that will be recorded as realized immediately, and there's a portion that will be deferred. And the calculation of those amounts depends on whether there's commercial substance or not. In the first part, part A, we're asked to assume that there's no commercial substance. Part A, assuming no commercial substance, the amount of the gain that is realized immediately is, go back, take a look. If there is no commercial substance, the gain that is realized immediately is calculated by taking the total amount of the gain, right? So let's do that. Total amount of the gain, 400,000 times other assets received. So other than the investment. So what is Garfield getting other than the 35% share in Jarhead? Is Garfield getting anything else? Getting cash, right? They're getting cash. Other than the investment, they're getting cash. So that cash is how much? 800,000. So 800,000 divided by, what is the fair value of the equipment being transferred? 2 million. Awesome. There you go. So the amount of the gain that will be realized immediately is 400,000 times the cash divided by total fair value, 160,000. That will be the amount of gain that is realized immediately. So how much of the gain will be deferred? What's left? 400,000 minus 160,000, 240,000. Okay, that makes sense. All right. So if you were doing part B, and I'll come back to the journal entries, I just want us to be able to calculate the amount of gain or loss. Part B is assuming commercial substance. There is commercial substance in the transaction. Then the gain that is realized immediately is basically the total gain times the other venturer's share. And that's basically nothing but 400,000 times, if Garfield gets 35%, the other venturers get 65%, yeah? So 65% of 400,000, $260,000. That's the amount of gain that is realized immediately. The gain that is to be deferred is the rest. 400,000 minus 140. Yeah, you guys all good with this? All right, awesome. So now let's take a look at the journal entries that they'll record. So this would be an entry on Jan 1st, 2001. And these are all in the books of Garfield. Can't spell. The books of Garfield, Jan 1st, 2001. Garfield is getting cash, the debit cash, and debit investment in Jarhead. And we've done the math. Garfield is going to get cash of $800,000 and $1.2 million in investment in Jarhead. What is Garfield giving up on? Garfield is giving up on equipment which has an original cost of $3 million and has accumulated depreciation of 1.4 million. Now, of course, if I look at this journal entry and I look at the sum of the debits, 3.4 mil, and the credit, 3 million, I know I'm out by $400,000 on the credit side. That $400,000 is going to be made up of two parts. First part is gain on transfer to JV. And the second part is unrealized gain, which is a contra account. Now, these amounts, as you noticed, will differ depending on whether there's commercial substance or not. If you were doing the journal entries, let's say for part A, part A said no commercial substance. The amount of the gain that you'll recognize immediately is 160,000, and the amount that gets deferred is 240. If, on the other hand, you say there's commercial substance, you'll have the same journal entry otherwise, right? You'll have the same journal entry. You will debit cash, you will debit the investment in Jarhead, you will debit accumulated depreciation, you will credit the equipment account. The only change will be the amount you credit for the gain on transfer and the unrealized gain. Okay, does that make sense? You go to recognize consideration received. We got cash and the investment in Jarhead. De-recognize the asset, so get it off the books. Credit the equipment at cost. Debit the accumulated depreciation. The difference is the total gain. Of that total gain, a portion is realized immediately, so credit gain on transfer, and the portion that is considered not realized is recorded as unrealized gain, and it acts as a contra account. Okay? This is as far your textbook takes you. What your textbook does not talk about is the fact that if the total amount of the gain on transfer is $400,000, then as far as Canada Revenue Agency is concerned, if you have transferred the asset, if the ownership in the asset is transferred over to another company, then that is a disposition, right? You've disposed of the asset. And the asset is deemed to have been disposed of at fair value. So if the asset is deemed to have been disposed of at fair value, then Garfield has to pay income tax on the gain. Now, I don't want to muddy the waters by taking you folks down the path of calculating capital gains and so on and so forth. Just to keep things civil and simple, assume that all kinds of revenues and gains and so on are subject to the same tax rate. So if the tax rate for our friend Garfield is 25%, Garfield has to pay tax on $400,000, the gain, on the transfer because that's a disposition in the eyes of the tax authorities. Garfield has basically sold its equipment, right? It's basically sold it to Jarhead. So that disposition will have triggered again, and that trigger, Isaac, no 50% inclusion, etc. Just ignore that part because that'll make everybody very, because income taxes, a course on income tax is not a prerequisite. So just that's why I said ignore those pieces that you already know. Just assume that all gains, all profits are taxed at the same rate. Okay, no inclusion rate differences. So there will be income tax paid of $400,000 or 25% of $400,000. But for accounting purposes, the immediate gain is only on the amount of the immediate tax expense should only be on the amount of gain that's realized. The gain that is not realized now, we should not record an income tax expense for it. So this difference here, right? So this difference, the venturer must pay income taxes on the entire gain in the year of transfer. However, for accounting purposes, the income tax expense will only be the tax on the realized gain. So, of course, the venturer is paying more tax than the income tax expense. The difference, which is basically the tax on the deferred gain, is a deferred tax asset. Okay, so your textbook actually does not deal with this piece. The fact that there is a tax impact resulting from the transfer. For CPA Canada, this piece must be covered. All right, so I can't help the fact that your textbook does not talk about this piece. CPA Canada expects that this is covered. All right, and I happen to be the subject matter expert for CPA Canada. I know what their expectations are. So I am going to cover that piece. Is that okay with you? All right, so please do not complain later on. Some of this stuff will be a little bit harder, but you'll have to stay with me on this. And I cannot do anything about your textbook. That's the best textbook we have in Canada, and it does not get into the details that CPA expects. I'm not going to start writing a textbook myself because there's no money there. So my apologies on that part. So again, I feel for you folks. Oh, there's not enough practice questions. You just have to balance it all out, right? Just focus on the understanding piece then. So we have to look at the deferred taxes piece. The second, so the deferred tax basically is going to be the tax amount on the unrealized gain, okay? So the way that is done is you also on Jan 1st, 2001, you're going to credit deferred income tax benefit income tax benefit, and this is the deferred portion. So the amount of the deferred income tax benefit is going to be the tax on the unrealized gain. So unrealized gain was 240,000. Our tax rate is 25%. Okay, so income tax benefit works out to $60,000. Instead of debiting the deferred tax asset separately, though, we will debit the unrealized gain contra. Okay, so debit the unrealized gain by the amount of the tax. Okay, this piece your textbook doesn't cover. Is it doable? Calculate the income tax on the deferred gain, and in your journal entry, debit the unrealized gain and credit income tax benefit. Because if you have you're recording a no, hang on, my bad. That's not true. It's not a credit the income tax benefit. It's credit income tax payable. And so the income tax payable is basically going to be on the entire gain, right? Income tax payable is going to be on the entire gain, 100,000. You want to debit income tax expense, and that income tax expense is going to be on the realized gain, 40,000. The difference is $60,000 that you're going to debit the unrealized gain. My apologies. So we are, as I explained, Garfield has to pay $100,000 in tax. The income tax payable will be 100,000. The current income tax expense is the tax on the realized portion. The tax on the unrealized gain is we debit to the unrealized gain contra. So rather than debit deferred tax asset, we debit the unrealized gain. Okay, are we good with that? Yes, no, maybe? Okay, so help me out then. If there is commercial substance, how much will I credit the income tax payable for? 100,000. How much will I debit the income tax expense for? So current income tax expense will be the tax on the realized gain on transfer. So the gain on 260,000 to 65,000. And then the difference is the unrealized gain. Okay. If you're good, that's basically part this first example. You recorded the transfer and you have adjusted for the tax portion. If Garfield was to prepare a balance sheet, if Garfield, oops, if Garfield prepared a balance sheet on January 1st, 2001, it would report the investment under long-term investments. Under long-term investments, it'll report investment in Jarhead. Now, what is the investment in Jarhead? 1.2 million. And the unrealized gain contra acts as a contra account to the investment. So subtract unrealized gain contra. Now, how much is the balance of unrealized gain? If you assume there is no commercial substance, what's the balance in the unrealized gain? Think, Pardeep, think. It's 180, right? Because you had 240,000 and then minus 60,000. When you debited the unrealized gain, it has an impact on the account, right? So 180,000. So net amount that is reported for the investment is $1,020,000. All right. If there is commercial substance, the amount will be $1,095,000. Why is there a difference between the two? The difference arises from our treatment of the realized and unrealized gain amounts. Is that okay? Good. Awesome. All right. I'm going to pause recording now, and I will invite you folks to digest this a little bit and then read up example 5.2. You should be able to get to example 5.2, read it up before I take it together. So I want you to digest this, go through this. Are you folks able to scroll up or down? Like I've shared the file. Are you able to move around or are you limited to what I'm showing? You can scroll. Okay, awesome. So I'm going to give you folks 5 minutes. All right, I'm going to give you folks 5 minutes to think about what we just did and also read up example 5.2. Then we'll take it up together. Okay, so here it's a continuation of in facts in example 5.1 typos. I just can't seem to get over. And we're asked to continue with the strand where the transfer of equipment to Jarhead possesses commercial substance. Okay. You're given information about what happened during 2001 and 2002. And the requirement is to figure out the amounts that Garfield would report in relation to its investment in Jarhead on its statement of comprehensive income and its statement of financial position for 2001 and 2002. So I'm going to first set up the answer, and then we'll talk about a little bit about how we get to the final numbers. So Garfield Corp will, on its statement of comprehensive income, the year ended December 31st, 2001 and 2002. What will they report related to this investment? They will basically report related to this investment two things, and these will be reported under other revenues and expenses. They will report, number one, the investment income from the joint venture, and they will report an amount for realized gain on transfer to the joint venture. Okay, so investment income and a gain on transfer to the joint venture. We will figure out what those amounts are in a bit. Now, as far as the balance sheet is concerned, Garfield Corp, on its statement of financial position, will report this investment under long-term investments. And they will report, as we mentioned, they will report the investment in Jarhead minus the unrealized gain contra. And we'll determine what those amounts should be. This is basically a blank template, okay? It's basically a blank template for the amounts that will be reported in 2001 and 2002. Now let's get to the calculations, and they're also asking for journal entries that Garfield will record for its investment in Jarhead. So we'll do that as well. First of all, let me talk a little bit about the journal entries. Basically, there will be 3 journal entries. There will be an entry for the dividend from Jarhead. Remember, we will be using the equity method here. So the dividend from Jarhead will, under the equity method, will result in the investment account going down. So in each of the 2 years, Jarhead paid a dividend, right? Paid a dividend, which means Garfield will have received the dividend, right? So debit cash and credit investment in Jarhead. In 2001, the amount of the dividend will be how much? Jarhead paid a total dividend of 100,000. What percentage of that is owned by our friend Garfield? 35. So 35% of $100,000 is 35,000, right? So they would have got 35% of 100,000, that's $35,000, debit cash for the 35,000, and credit the investment in Jarhead by the 35,000. Similarly, in 2002, the total amount of the dividend paid by Jarhead was 120,000. Of that, 35% will be received by Garfield. So 120,000 times 35% is $42,000. Debit cash, credit the investment in Jarhead, 42,000. Okay? Second bit, the second journal entry that Garfield will record related to its investment is to record the investment income. Right, so investment income. To record the investment income, they're going to debit the investment account and credit investment income from Jarhead. This amount needs to be calculated according to the equity method, right? This has to be calculated, must be calculated. So see note 1, let's say. We will calculate the amount and get back to it. The third entry that Jarhead will record or Garfield will record is for the realized gain on transfer. A portion of the gain on transfer. Remember, we had deferred a certain amount of the gain on transfer, the contra account. And I said that gain does not remain unrealized forever. There's a gain, the portion is deferred and it's realized, it's recognized later over the remaining useful life of the asset. So in our case, the equipment that was transferred had a remaining useful life of approximately 10 years at the time of transfer. So whatever is the amount of the deferred gain, it will get realized over 10 years. Yeah. So here, $180,000, as you can see, $180,000. Off that $180,000, each year, 1/10 will become realized. Okay, 1/10 will become realized. And that 1/10, as it becomes realized, so as the contra, so what happens if the contra asset account goes down? What will happen as a result? If the contra asset goes down, will something happen to the investment account, the investment in Jarhead? The investment goes up. Awesome. You have to keep that in mind. As a result of the contra asset going down, the investment account will go up. So that's part of what I'm getting at. So we will debit the investment in Jarhead. And if there is commercial substance, we're talking about this guy here. So if there is commercial substance, then we're dealing with 105,000 of the total unrealized gain. Over 10 years, each year, what amount of this gain will become realized? $10,500. Awesome. So as this unrealized gain contra decreases by 10,500, the investment in Jarhead is going to go up by 10,500, right? So 105,000 divided by 10, 10,500 will debit investment in Jarhead. We will credit, and this is important to remember, credit the gain on transfer to the joint venture, not investment income. You want to credit the gain. Now, for crediting the gain on transfer, see, the original before tax amount of the unrealized gain was $140,000, right? Under commercial substance, we had deferred $140,000. On the 140,000, we said the tax was 35,000. So the realized gain before tax is 1/10 of 140,000 or $14,000. So 1/10 of 140,000 is 14,000. The difference is basically the tax. So as the gain becomes realized, a portion of that gain is subject to tax for accounting purposes. So you're going to record debit income tax expense. And this is essentially the deferred portion. So it's the deferred income tax expense, $3,500, and the net amount, 10,500, is added to the investment account. Okay? So in 2001, that happens. And in 2002, the same thing happens. The investment account will go up by 10,500. The before tax realized gain is $14,000. And there is an income tax expense resulting from that gain. 25% of 14,000 is $3,500, and it will be shown as a deferred income tax expense. Yeah, I'm seriously into kind of complicated territory here. So I want to hear from you folks. How does that feel like? Does that make sense? Okay, if everybody good? Okay, so then the only piece that's left missing is the investment in Jarhead. So if I kind of go back and I go, okay, gain on transfer, I have every year $14,000 as the gain on transfer. Figured that out. To figure how much the investment income is, I need to do some calculation. And that is going to have an impact on this other guy as well. So I have to wait until I do the calculation of the investment income. So are we ready? Calculation of investment income. Okay, so here, pay attention, very close attention. The calculation is going to be initially based on Jarhead's net income for the year. So for the year 2001, Jarhead's net income is 400,000. That's our starting point. Jarhead recorded net income 400,000. Now this amount under the equity method is subject to adjustments. So what are the adjustments? You will have adjustments for amortization of fair value differences. Well, there's no fair value differences here because Garfield is the founding venturer. Garfield did not acquire its 35% share from somebody else. There is no acquisition differential. So as a result of that, there is no fair value differences and there are no goodwill. Okay, so there's no fair value difference, no goodwill. But what we do have is intercompany transactions. Okay, so I got intercompany transactions here. In 2001, Garfield sold inventory to Jarhead for $100,000 at a gross profit margin of 40%. Jarhead sold 60% of this inventory to outside parties by the end of 2001. So we're dealing with intercompany profits. Then for 2001, for 2001, We got tax at 25%. And after that, for 2001, we would have a unrealized profit in, now Garfield happens to be the venturer. If Garfield sells to Jarhead, then that's a downstream transaction. So unrealized downstream ending inventory profit. Okay, so we're going to have an unrealized downstream ending inventory profit. The amount of the profit will be, so total inventory sold is 100,000. The gross profit margin is 40%. So 40% of 100,000, $40,000 was the total amount of the gain, of which 60% became realized when the inventory was sold to outside parties. So what is still unrealized at the end of 2001 is the remaining ending inventory, which is 40% of the total. So the amount of the profit, the intercompany profit that's unrealized is 100,000 times 40%, which gives us the total amount of the profit, times 40% again, $16,000. The tax rate is 25%. That's 4,000. After taxes works out to 16 minus 4, 12,000. And the other intercompany profit that existed in 2001 is in 2001, Jarhead sold land with a book value of $200,000 to Garfield for $250,000. So we have an unrealized upstream, because Jarhead was the seller, upstream land gain. The total amount of the land gain was $50,000, 250,000 minus 200,000. Hang on, extra zero there, $50,000. Now with land, keep in mind the gain, the intracompany gain on land can only be realized if the land is sold to an outside party, right? Land is not depreciable. Now, none of that happened in 2001. So the total amount of the land gain is unrealized. Tax on it is 12.5, after tax 37.5. So Feroz, we are looking at the amount of the unrealized profit. So we say intercompany profits become realized when the asset is sold to outside parties or is depreciated. So with inventory, there's no question of depreciation, but inventory is sold to outside parties, yeah? So total amount of inventory sold in 2001 was $100,000. The gross profit margin was 40%. So the total amount of the profit was $40,000. We said, okay, this $40,000 profit is unrealized until the inventory is sold to outside parties. So of the inventory, 60% was sold to outside parties. So that 60% got realized. What remains unrealized is 40%. Okay? Good. Awesome. So for 2001, there's two intercompany transactions that we have to worry about. There's the downstream inventory profit, and there's the upstream land gain. So we'll say 400,000, that's great. For the adjustments, we want to take the unrealized downstream ending inventory profit, and we want to take the unrealized upstream land gain. Now, we're making adjustments to net income, which is an after-tax concept, right? Net income is an after-tax affair. So if you make any adjustments to net income, you got to make adjustments using after-tax amounts. Secondly, if you're saying that this ending inventory profit is unrealized, it's not real, it's make believe, if you will, then this $400,000, the adjustment that you must make for this make believe profit is to hold it back. Okay, you want to hold back the profit when saying this profit is not realized, so I can't include it in my investment income. So if I can't include it, I must, by definition, exclude it. To exclude something, what must you do? Minus. Awesome. So you want to go ahead and minus the after-tax amount, okay? Because you're adjusting net income. So when you're adjusting net income, you must use after-tax amounts. So minus $12,000. Similarly, for the unrealized land gain, you will minus $37,500. All right. So we now get Jarhead's adjusted net income for the year 2001. We get Jarhead's adjusted net income $350,500. Out of this 350,500, Garfield's share is 35%. So the investment income for the year 2001 happens to be 35% of 350,500, 122,670. You guys good with that? Take Jarhead's net income, make adjustments for the intercompany unrealized profits. You get the adjusted net income, take Garfield's share. That's basically what we learned in topic 4 as well, the investments in associates. Okay, is that good? Awesome. So if you got that, then you can go ahead and complete the journal entry for 2001. Debit the investment in Jarhead, 122,675. Credit investment income, 122. Investment income for 2001 is 122,675. That good? Okay, so we tried to do the math for 2002. Jarhead's net income for 2002 is $500,000. To this, you're going to make adjustments. Now, 2001's ending inventory becomes 2002's beginning inventory. Following the logic of first in, first out, what do you expect to have happened in 2002 for this inventory? Like, what do companies typically do with inventory? Sold. All right. So if the inventory gets sold, Hugo, what's the result on the intercompany profit? The inventory sold. What happens to the intercompany profit? It's realized. Exactly. So now what we must do is the last year's ending inventory profit becomes realized in the current year. So you want to add. So you want to add $12,000 of last year's ending inventory profit. All right. For the land, the only way the land gain gets realized is if the land were sold to an outside party. So we're going to wait on that. Let's see what happens in 2002. In 2002, Garfield sold inventory to Jarhead for $140,000 at a gross profit margin of 40%. Jarhead sold 70% of this inventory. So again, we're going to have an unrealized downstream ending inventory profit for 2002. The total amount of the sale was 140,000. Gross profit margin was 40%. Now, of the total amount of the inventory, 70% was sold to outside parties. What remains unsold is 30%. So if you did the math, 140,000 times 40% times 30%, that's $16,800. That's before taxes. So calculate the tax on it, 25%, 4,200, and you get $12,600 as the after-tax amount of the profit. Also, in 2002, Garfield sold half of the land that it had bought from Jarhead to a third party. So out of this unrealized land gain, right? So the unrealized land gain, so the intercompany, the upstream land gain in 2002, the unrealized balance on January 1st, 2002 was 50,000. Out of that 50,000 realized in 2002, we sold half the land, half the gain got realized. So half of 50,000 got realized. Okay. So it totally depends on how much of the land is sold to outside parties. If if 1/3 of the land was sold to outside parties, then 1/3 of the gain would have been realized. 25% was sold, then 25% of the gain is realized. Doesn't matter how much the land is sold to the outside party for, because that is already captured in Garfield's separate company income statement. We're concerned with the intercompany profit amount, and that the amount that gets realized depends on how much of the parcel of the land is sold. If all of the land had been sold, then all of the intracompany gain will have become realized. Okay? So since it said half the land was sold, half the gain is realized. So at the end of 2002, you still have a balance of $25,000 remaining. You can calculate tax and after tax. We are concerned with this guy here, right? What happened in the year 2002? So we're going to pick up on the amount that is realized in 2002. So out of the land gain, what happened in 2002 is a portion of the land gain got realized. Because the gain got realized, you want to add. So realized upstream land gain, add 18,750. And then for the unrealized downstream ending inventory, you want to subtract 12,600. So three adjustments in 2002 here. Jarhead's net income adjusted for 2002 is $518,150. Garfield's share is 30%. So the investment income, or 35%, I'm sorry, 35% of 518,150 is 181,353. For 2002, our investment income is 181,353. You want to go ahead and debit the investment in Jarhead, 181,353, and credit investment income. Yeah, we good on that? So she's question is for realized gain on transfer, shall we debit unrealized gain contra? So that is, oh, you're right. Oh, because we didn't close the unrealized gain. I'm so sorry. I'm so sorry. Yeah. It should be debit the unrealized gain contra. You're right. Sorry about that. You want to no, not here. This guy. You want to debit the unrealized gain contra. Yes. No, you're right. The unrealized gain goes down, and that's why the investment account goes up. Very good catch. Thank you. How are we doing so far, folks? So are we good with the calculation of investment income? Investment income, 122,675 for year one, 181,353 for year two. Actually, this is not completely true. We still have a little bit more. But are you caught up with this before I don't want to end up confusing you guys too much? So let me ask you this. The calculation for the investment income, is that understood? Because that's pretty much on the same lines as we learned for topic 4. Oh, now, this is where things get a little bit murky. Okay, so stay with me. Investment income is fine. Now, what about the gain on transfer? I got $14,000, but that's recorded at the end of the year. Am I forgetting the fact that I also have a gain on transfer from the beginning of the year on Jan 1st? So if I want to report the amount of the total gain on transfer, do I also not have to go and add the $260,000 that was realized at the beginning of the year? So total gain that is realized for 2001 is not only 14,000 at the end of the year, but also 260 from the beginning. All right, so if you're talking about the total amount, that's what it should be. $274,000 for 2001. And secondly, to calculate the investment account, probably a good idea to prepare a T account. Investment in Jarhead. Now, our beginning balance of the investment in Jarhead was 1.2 mil. Right, that was the beginning balance. To that amount, we will make an adjustment for dividends. So in 2001, the amount of dividends was 35,000, and that will cause the investment account to go down. We will have investment income, and that will cause the investment account to go up. So at the end of the first year, the balance on December 31st, year 1, for the investment account is 1.2 mil, add the investment income, subtract the dividends. So you get 1,287,675. Similarly, if you make a T account for the unrealized gain, the unrealized gain was originally recorded at 140,000. We credited it by the deferred tax of 35,000. So we had a beginning balance of 105,000 as a result. During the year, what have we done? We have debited the unrealized gain by $10,500. So the balance on December 31st, 2001 for the unrealized gain will be 140,000 minus 35,000 for the deferred tax minus 10,500, the amount that got realized in the current year. So at the end of the year, you're going to have unrealized gain of $94,500. The net amount of the investment is 1193175. At the end of 2001, the investment will be reported at 1,193,175. You guys good with this? It's basically now time to post all the transactions to the T accounts. Do you guys want to try doing the 2002 calculations? Like what should be the amounts for 2002? Just going to pause the recording for a couple of minutes, give you folks a couple of minutes to think about the math. Let's see what we have for 2002. We're going to continue with the investment in Jarhead account, the account. And what happens in 2002? Again, we will be reducing the investment account for the dividends. In 2002, dividends were 42,000. The investment income for 2002 is 181,353. So that will give us an adjusted balance for the investment account on December 31st, 2002, 1,427,028. Absolutely, Hugo's got that number. So 1,427,028 will be the amount of the investment. For the unrealized gain, realized in the year 2002 is another 10,500. So at the end of 2002, the balance in unrealized gain will drop even further from 94,500. It'll drop to $84,000. And so the investment account and the balance sheet for 2002 is reported at 1,343,028. So at the beginning of the year, Brittany, we had a deferred tax portion of 35,000. Remember, we debited the unrealized gain for 35,000. That was basically the total deferred tax portion. Remember, the unrealized gain was 140,000 minus 35,000. All right, so that was the end of question 5.2, example 5.2. Fairly exhaustive question if you think of the fact that it's linking back to example 5.1. So quite a bit to review on this. This will be an example of a joint venture where the venturer is a founder venturer.